25 basis points, 7 hikes total, netting out the one that just happened, 6 left for the rest of this year, but also bringing up the balance sheet. That caught a lot of people off guard. Were you surprised?
Little bit surprised. Well, first of all, the Fed's language, I think, was a little bit more aggressive than we and others were looking for. They did only go by 25 basis points, but the tone has moved significantly. The risks around COVID seem to be pushed to the background, and it's all about the Russia-Ukraine conflict. So that's going to be, it looks like the driving force behind the Fed's decision, and the balance sheet as well. The balance sheet's kind of been in the background for a while, but not only stopping asset purchases, but starting to unwind them. That just points to a Fed that realizes that inflation is a real issue, and they need to withdraw monetary stimulus, and that's a combination of raising rates fairly aggressively and shrinking the size of the balance sheet. So the whole package was a bit of a surprise today. The markets seem to like it, but the Fed's got a bit of work to do to get inflation back to its target over the next year or so. So I think this was completely consistent with that.
For EM, what do you think? We've got a fresh rate hike cycle underway, and when you layer on what they intend to do with the balance sheets, they're going to start attacking that probably sooner and more aggressively than a lot of people had earlier thought. Does that mean for EM, be afraid or be very afraid?
It's a different challenge for emerging markets than it is for the advanced economy. So let's kind of divide the inflation story into two pieces. We've got the jump in energy prices and the ongoing effects of the supply chains. And, that's a supply impulse that major central banks, and I would say the more credible central banks, can look through. They really want to look at demand-driven inflation or domestically driven inflation and gear their policy toward that. If the central banks are less credible and the market isn't thinking that they can deliver their inflation target only looking at domestic variables, then they have to pay attention to things like global energy prices, global supply chains, and that's mostly EM. So you're right in saying there's a bit of a difference between an EM central bank and an advanced market central bank. The risk here for EMs is that we've got a big short-term jump in inflation. Even if we think growth is going to be slower now, and that's our forecast, if we think growth is going to be slower and demand pressures are going to be slower over the next year or so, EM central banks with less anchored inflation expectations may have to react in the short term and raise rates and tighten monetary conditions to fight spillovers from the initial inflation shock. Advanced country central banks are not going to have to do that. So if you're looking for a wedge between EMs and DMs and something that might move the needle for the former group, I think this is something we could potentially focus on.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.